the feds are going to start money printing again like they did back in, 2020 or something. And remember how much inflation that caused? Let's jump into it with ClearValue Tax and get the whole scoop on the story.
Back in 2024, I made the prediction that the Federal Reserve will start the money printing process again in 2026. And guess what? 2026 is right around the corner. So where do we stand? I want to show you. Here's what the Fed president in New York, John Williams, said in November, which went largely unnoticed by the public. He said that the Federal Reserve will soon need to grow its balance sheet again. And honestly, that's just a nice and fancy way of saying that the Federal Reserve will soon need to turn the money printers back on again.
Yeah.
And he didn't say maybe or years from now. No. Williams said that I expect that it's not going to be long before it happens. So are we on track for the Federal Reserve to start their massive money printing again in 2026? And I'm going to take an educated guess and say yes.
Yes, dude. They're going to start it up again, and then what's going to happen is inflation's going to go rampant again. Just when we started getting it, I wouldn't say under control because the prices never come down really with things, but at least they haven't continued increasing like they were. But we're going to see it again. So get ready and gear up.
Now, I want to tell you where we officially stand. Quantitative tightening ends on December 1st. So that's not speculation. That is official, confirmed by the Federal Reserve. So I just want to clarify this so that we're all on the same page. Quantitative easing is another fancy way of saying money printing. So there's a lot of ways to say it. There's balance sheet expansion, there's quantitative easing, QE. They all mean the same thing. They all mean money printing.
Yeah.
And printing money, it floods the financial system with more money and with more liquidity, and it energizes the economy.
It's probably going to get interest rates to go down at least. So if you are cash rich and you hold that money for a little bit, at least the interest rates will go down if you need a loan.
Okay, but what happens if there's too much money and there's too much liquidity in the financial system?
We've seen
in
that
type
happen.
of situation, you're going to have more cash chasing after the same amount of goods and services, and then prices are going to inflate higher. Now, I just want to say that wouldn't be a problem if everyone received an equal amount of that newly printed money, but of course that never happens. It doesn't work like that. And if there's too much money in the system because they overprinted and we have soaring inflation, then how are they going to fix that? Well, the Federal Reserve, they're going to want to drain money. They're going to want to drain liquidity out of the system. And that's called quantitative tightening, which is the opposite of money printing.
Yeah.
Okay, so QE is money printing and QT is taking money out of the system.
And we're going into QE.
Now, to bring you up to speed, I want to give you this quick little recap. The pandemic happened, right? And the government told the majority of Americans to just not go to work. Just stay home. Only go to work if you're an essential worker. And of course, that destroyed the economy. To save the economy from the self-inflicted wound, they printed trillions of dollars, which of course caused raging inflation.
Massive inflation. We all saw that.
I mean, how else would millions of Americans pay their bills if they're being told to just stay home and not work? They had to print the money, which spiked inflation.
Yep.
But here's what happened. They overprinted. They printed too much money.
So
for the past 3 years, the Federal Reserve has been shrinking their balance sheet from $9 trillion down to $6.6 trillion. In other words, they've been removing money out of the system to tame inflation. Now they're stopping the tightening process.
And like, look at this chart. It never goes down. Like, these numbers will never go down to where, like, you know, the good times or whatever. It's going to continue going up. Based on just kind of what we're looking at here, if they're going to start quantitative easing again, it already hit 9 trillion before. I don't see why it won't hit at least that again. At least, probably more.
Process completely on December 1st. And again, I'm taking the educated guess that they're going to start the quantitative easing, the QE process. They're going to kickstart that very shortly. Williams said, he said what he said about turning the money printers back on. Jay Powell, who's the chair of the Federal Reserve, he said the same thing in October. He said that at a certain point, reserves will have to start growing gradually. So Dallas Fed President Lori Logan said the same thing. If repo rates keep rising, the Federal Reserve will need to begin buying assets. So again, another fancy way of saying money printing. And Evercore, one of Wall Street's most respected macro firms, said that the Federal Reserve may need to buy up to $50 billion per month in the first quarter. Now, I want to bring this to your attention. a very good question is, why is the Federal Reserve doing this right now? What's the motivation? What's the real reason? Because if you think about it, the economy is not crashing, at least not right now. And the
You
Federal
see, like they're saying no recession risk, but then if you look at Warren Buffett and his Buffett indicator, he took all his money out and he's got hundreds of billions in cash. And these billionaires only do that when they're expecting a downturn in the stock market. And I bet you like gold prices are going to go up a lot more simply because people are that have that inside info. They're going to see that the where the market's headed and where the country's headed, and they're going to see that they're going to do quantitative easing again, which is going to devalue the dollar and make the gold price go up. So they're going to put all that money into gold and assets like that are going to appreciate in a situation like that. While the rest of us, like regular people, were kind of screwed.
Federal Reserve, they're not doing this because there's a crisis happening at this very moment. So the reason why they're doing this is because of the mechanics of the financial system. The financial system cannot function properly if there's not enough reserves. The banking system runs on, you could just say, a financial plumbing system of reserves, the repo market, collateral, treasury bills,
people are broke,
and short-term
so
financing.
Repos are way up.
So I said like a plumbing system of all those things. Just think of it like a plumbing system. If there's not enough water then in the system, then it's not going to function properly. Okay, so the Federal Reserve has been shrinking their balance sheet and reserves have been falling. And if reserves are going to go down too far, then the repo rates, they're going to spike up. And when repo rates spike up, then the money markets are going to break. But listen, we already saw this in 2019, the repo crisis, in 2020 because of the pandemic, and now again in 2025. So yes, the Federal Reserve is stepping back in, but they're not doing it to stimulate the economy. No, they're doing it to keep the plumbing system from breaking. But listen, when the Federal Reserve expands their balance sheet, there's always going to be an effect. And the effect's going to be more liquidity in the system. It's going to be lower real yields, higher valuations, and increased risk-taking. And this is all going to cause more upward pressure on financial assets. And it's not just me saying, there's other people like Ray Dalio. He's just one of many examples that's sounding the alarm. Ray Dalio, he's the founder of Bridgewater. It's one of the largest and most influential hedge funds in the world. And he said that the Federal Reserve is basically stimulating into a bubble. And he says that the key ingredients are already there. High stock prices, large fiscal deficits, high inflation, and now we're talking about new quantitative easing. And I just want to say that Ray Dalio is pointing out that this combination is very inflationary and very dangerous.
It is.
Dalio expects that this additional liquidity is going to push up the price of investments just higher and higher until inflation becomes so severe, and then the Federal Reserve is going to have to respond by just slamming on the brakes. And that's going to cause a severe correction. Okay, so
I mean, I can see Bitcoin soaring then imploding because that's what it does. I don't see historically gold like imploding. It could correct, but I mean, either way, if you don't even have to like really time it. It's like, dude, if you have cash sitting around and you don't want your dollars to lose value, buy some gold. I mean, it's a store of value and it keeps going up.
I just want to
and with that said, when it corrects, just keep it, pull out whatever. But our dollars are going to go less further than they currently do now.
make this crystal clear that Dalio is saying that basically there's going to be a melt up. So he's saying that when we melt up, that's the time to sell, not right now. He's not saying sell right now. He's saying ride the wave up because of inflation and then just get out before the crash. And here's something that I want to point out because this is huge. It's going to be a major policy shift for the Federal Reserve. Jerome Powell, who's the chair of the Federal Reserve, his term is expiring. It's going to be over pretty soon, May of 2026. And who's going to be the person that chooses his replacement? It's going to be President Trump. And if you've been following, you know President Trump's stance on the Federal Reserve. He's repeatedly said that interest rates are too high, that the Federal Reserve was just too slow to cut interest rates. The Fed should support growth. The Fed should help manufacturing and exports.
I remember them saying that.
And he basically wants lower borrowing costs. Okay, so what's going to happen when the next Fed chair aligns more closely with President Trump's views about monetary policy? then you can expect a more dovish Federal Reserve, more tolerance for inflation, a more, you could say, willingness to cut interest rates more aggressively, and more support for growth and liquidity. Okay, so you know what? Let's throw that one into the mix of ingredients that we're already working with. So we have high stock prices, large fiscal deficits, high inflation. We're going to have new quantitative easing, money printing, and now you're going to have a more dovish Federal Reserve. I don't know what you think about that, but for me, when I see that mix of
it's lining up to make the rich richer, just like everything else.
Ingredients, I see that it's got melt up written all over it. Okay, so here's the bottom line. The Federal Reserve is warming up the money printers. You could call it QE, you could call it balance sheet expansion, reserve management, you could call it technical operations, whatever you want to call it, doesn't matter. What matters is that liquidity is coming back into the system. Mm-hmm. Okay, so what did I say before? Interest rate cuts come first, and then they stop QT, and then they turn the money printers back on. And then, of course, inflation is going to reaccelerate. I just want you to remember that every money printing cycle requires a greater quantity of money to be printed. You could think of it like an addict that requires a greater dosage, and it's going to end.
It's like you get used to the. That's a great analogy. Like you get used to the high that it gets you, and now you need more to reach that same level of euphoria. This is all. I mean, ClearValue Tax. He's like giving us very good info that lines up with everything that the big players are saying. If you have money or you have a way to stack up money and be kind of cash rich in the next 6 to 12 months, this is where the rich are going to get richer, and you're going to have some kind of buying opportunity or investment opportunity simply because prices temporarily are going to go down, and interest rates are going to go down, and then it's going to go up severely again like we were going through. This is going to suck.
Very badly. Okay, now let's talk about what you can do with this information, because understanding that liquidity is coming, that's one thing, but positioning yourself for it is going to be something else. So I want to give you some quick practical tips, common sense ways to approach this. So the first thing I want to tell you is that you should follow the liquidity, not the headlines. When the Federal Reserve adds liquidity, even though they don't call it quantitative easing, they might call it some fancy other term, this or that. But it's going to be quantitative easing. It's going to be money printing. It's all these
actions, not
different
the
words for the same thing. So even if they claim it's not stimulus, the market's going to react like it is. So this typically means higher valuations, compression in yields, and more risk taking. So you don't have to predict anything. You just have to understand that liquidity is going to drive the markets. Now, the second thing that I want to tell you is to not chase the melt up at the top. You want to build your positions when there are pullbacks, because it's not going to go up in a straight line.
Don't buy at the top, dude. That's
what I'm saying is that smart investors, they don't chase those parabolic moves. They buy the dips, not the euphoric spikes.
Yeah.
So you don't have to time the bottom. You just have to avoid chasing the very top. The third thing that I want to tell you is to diversify across multiple assets. So just don't put all your eggs in one basket. Don't make just one big bet.
Yeah.
I just want to say that in liquidity-driven environments, stocks can go up, crypto can go up, precious metals can go up. Nobody knows for sure what's going to be who's going to be the fastest horse in the race. But listen, I want you to think about it like this. Like, if you think that stocks are going to outperform, then what do? Do you buy a broad basket of stocks like the S&P 500, or do you go with AI? Or because of all this AI, it's going to require additional energy, then do you buy energy stocks?
Yeah.
Or if you're going to say, okay, crypto's going to do the best, then do you just buy Bitcoin, or do you buy, altcoins? Altcoins are going to outperform.
Yeah.
And even if you're within precious metals, do you just buy gold, or just buy silver, or just buy platinum, or how about just the miners?
I mean, a lot of people can't afford, people can't buy one whole Bitcoin. Obviously, you don't need to have a whole Bitcoin. People can't even afford an ounce of gold. The price is over 4K now, but even to buy it with the what do they call it? I forget what they call it, but the extra premium, you're looking at like $4,500 an ounce. A lot of people can't afford that either.
Right. Listen, I'm not saying that you have to buy a little bit of everything, but I'm just saying that, you should be diversified across
buy
asset
a couple
classes.
of things. Like
But listen, if you want me to
not
speak
just
to you
one.
plainly, like just tell it to you straight up. What I'm
Yeah,
saying is, like,
let's
if
hear
you're a
that.
crypto bro, like you love crypto, I am advising you, like, diversify some of that out. Like, buy some precious metals. If you're hardcore about precious metals, you should really think about putting some money into equities. That's all I'm saying. Just stay diversified. And this last one, the fourth one I want to say, I think this is so important because I've seen so many people get ruined by this. You have to be careful with your margin debt. Even in a melt up, your investments, they're not going to go straight up. There's going to be pullbacks. There's going to be ups and downs. If you borrow money to buy stocks or crypto, that's going to be known as their margin debts, then you can get wiped out in a downswing and you're not going to be able to recover when it starts going back up. So don't let this happen to you because I've seen this happen to so many people, like, personally, that I know. So if you don't understand the situation, like, let's just say you have $100,000 to invest. I'm going to keep it a nice, clean, easy number. If you have $100,000 to invest, you can buy up to $300,000 worth of stocks or crypto with margin debt. You're
I
basically
wish I
borrowing
had that
money.
kind of money. Most people right now do not have that kind of money to invest. Most people are barely scraping by, and it's just going to get worse.
To do so. And if you do that and your stocks go down 33%, then you're going to lose your entire $100,000. And then when the market goes back up, guess what's going to happen? You lost all your money, so you're not going to be able to enjoy the upswing. You're not going to be able to recoup your money. People get wiped out in raging bull markets because of their dangerous debt levels, and I don't want to see that happen to anybody. Okay, so that should help to bring you up to speed. And if you want to see what I'm doing personally with my investments, you can always check out my Patreon, which I'm going to leave a link for you down below. Thank you.
Cool. Yeah, go visit ClearValue Tax's Patreon. This guy is legit. He gives such good info. Ultimately though, it's like most people we're gonna get hurt again. We're gonna get hurt big time. If you've been enjoying fancy stuff these days, you've been enjoying vacations, steak dinners, getting your girl's nails done, whatever we're talking about, that's gonna get a lot tougher. It's just gonna get a lot tougher. Like, comment, subscribe. We'll have more fun on the next one.